So, recording. So, thank you everyone for joining. Dan Eck from EY is going to present today on tax withholding 101. And so, if you have any additional questions about this, you can reach out to EY. I'll turn the call over to Dan. Thank you.
Great. Thanks so much, Travis. And applaud those of you, it's a small crowd, that have decided to focus on taxes as early as the 18th of January. We are recording this for a reason. I know this gets more and more popular as a topic as we get closer and closer to April 15th. And so this is being recorded. And so welcome to all of those that are watching this in February, March, when you realize taxes are due yet again. I love this topic. I like talking through this. I think you'll find a few very specific nuggets and action items and a few resources that you may find some value in as we go through the discussion. So do pay attention, grab those as we go. We're going to try to keep the comments to about 30 minutes, may take a little less than that. And then happy to open it up to any questions that you might have for those that are on live. And we can talk as long as we need to about this topic. But of course, you have other resources available to you as well after today, and it starts with this one. So let's talk first about the EY Navigate tools and resources. These are all made available to you at no cost by PBUCC. These are financial education and financial planning resources that are open on an unlimited basis for each of you that are members of PBUCC. It starts with the EY Navigate Planner line, which means you have free and unlimited access to your own financial planner that you can talk to confidentially and objectively about any financial matter that you may be dealing with in life. That certainly includes tax questions and tax issues. We are experienced financial planners that talk to PBUCC members every day. We understand your benefit plans, the retirement plans, and again, can talk any aspect of financial planning. If you're having trouble paying your bills, want to talk about debt reduction, develop a plan for retirement, talk about your taxes, insurance, or anything else, please give us a call at the number you see here. Open Monday through Friday, 9 to 8. Again, no cost to you at any point. We don't sell anything. So it is truly an objective conversation focused just on you, your family, and your needs. And again, you can talk as often as you like, as long as you like, and importantly, with the same financial planner each time. So when you call and you get Deb and you like Deb, Deb's your financial planner, and you can have that relationship for as long as you might need it, for years down the road, even all the way until and even after you retire. If you like to do things on your own, you have access to EY Navigate Digital, which is both a website and a dedicated app that you can find on your app stores that allows you to do the same financial planning and financial plans totally on your own. You could develop your own retirement plan, a debt reduction plan, learn more about a host of financial planning topics through videos and articles and newsletters. And importantly, you can also connect directly with your financial planner at any time. So some folks will start on the website, get as far as they can, decide I've done all I can on my own, I'm ready to talk to a planner, and you can click a button and ask to be connected with a financial planner. We'll assign one to you from our program. And if it's during working hours, you may be able to even talk right then and there, either through chat or live on the phone. Once you start working with a planner, then you can connect directly through the website as well. You can send messages back and forth, share documents, schedule appointments, and then of course, talk on the phone. We also offer some group learning opportunities. Every month, we deliver a hot topic financial planning webinar that's open to individuals across all of our clients at EY that anyone can register for. And you can find those on the EY Navigate Digital website and app. You can register for those at no cost. But PBUCC through EY also offers financial education throughout the year. And that's done primarily through this Power Up Your Finances series. So we do one of these topics every month. Today is on taxes. So I encourage you to look at those and register for a future Power Up session, as well as any of the EY sessions you find on the website. So the first resource today are the free, objective, confidential EY financial planning resources that if you haven't used, I hope you do, and give us a call. As I say in every workshop I've ever delivered, the most important moment of this session will occur at about 3:30, 4 o'clock Eastern today. And when we're all done, we say goodbye. I thank you for attending, and you go back to 30 or 40 emails and other responsibilities that we have in life. And it's easy to forget what we talked about here today, what you learned, and some of the action steps that you decided were very important to address. If we don't capture those, it's easy to lose sight of those. So I ask you to grab a piece of paper or the notepad on your phone, write the word personal action plan at the top, And all I ask of you today is just sit back, relax, do ask questions, but also jot down any action step that either I suggest or that occurs to you that you need to follow up on. And then keep that list somewhere very obvious on your desk, on the kitchen table, or on the refrigerator. And make sure you address at least one of those by the end of the week. Pick the easiest one, that's okay. Do the next one on the list after that, and keep that momentum going to do the things that you decided were important, to really find the value in the conversation that we have here together today. So our topic is tax withholding 101. So we're going to talk taxes at a fairly base level because we do find this is one of the areas as we take calls on the EY Navigate Planner line where a lot of folks have confusion. So for those that understand this slide, my apologies, and I appreciate that you have that understanding. A lot of folks do not. So let's talk about the U.S. tax system that we all are subject to. We call it a pay-as-you-go system because truly that's how it's designed and that's how it works. We are expected during the year, as we earn income, to pay some estimate of income tax on that income, not just at the end of the year or not just at a certain quarter later in the year or when we file our taxes. But the U.S. government expects us at least quarterly as we go through the year, as we earn income, to send in some money that is an estimate, a fair estimate of the tax we're going to owe on that income. If you're a self-employed individual, you probably know this process well, and it's kind of a pain. You have to do some calculations. But for many of us who get paid every couple of weeks through a W-2, we're a W-2 employee, we're just a regular employee, it happens automatically through what we call withholding. So you've heard of withholding, you understand that process, which we'll talk about today. That is our way of complying with this pay-as-you-go system. If you get paid every 2 weeks you get a paycheck. It's not quite the full amount you expected because some of that pay was sent off to the IRS as an estimate of the tax you'll owe on that 2 weeks of pay. And in 2 weeks, you'll do exactly the same thing again. So as we go through the year, we are paying as we go. If we are self-employed, we might have to send in quarterly estimated payments that really accomplish the same thing. But all those payments are our estimates, and they're close estimates if we do the calculations right. But there's another step to this U.S. tax system process. At the end of the year, by April of the next year, we have to settle up with the government, with the IRS. So starting in January, we gather all of those tax documents that come in the mail. We fill out our Form 1040, and that's the process of settling up with the government. We show the IRS exactly what we actually earned last year. We take advantage of any deductions they allow us to take, any exemptions, any credits that are available to us. And we figure out how much tax we actually owed for the prior year. And then we just compare that to what we sent in during the year through withholdings or estimated payments. And we settle up. Here's what I actually owe you for the year. That's okay. I already sent you this much. And as we all know all too well, if we sent them too much, we get some of it back. We get a refund. We settle up with the IRS. We show them we sent them too much, and they give us that difference back. And if when we settle up, we find we haven't paid the full amount, then we have to write a check with that tax return, and we have to pay that by April 15th. So if we get a refund, it just means we've overpaid our taxes during the year. We estimated a little high. Maybe we got a credit on our tax return we didn't expect, and we get that excess back. If we send in a payment, that means we didn't pay quite enough, and we're just finishing off or settling up and paying the difference. So we're all good for the previous year. Again, a lot of you understand that, but there's some nuances in there that are important to review every tax year. And of course, there's pros and cons of getting that tax refund. We all are excited to get the tax refund. And when you hear about it talked about on the news or on TV ads for tax preparers, it sounds like a win. If I got a bigger tax refund, I did everything right. I won. I did a good thing. And it certainly feels that way because we get some money in the mail. There are benefits to getting that tax refund. It's kind of a way of forced saving. So either intentionally or unintentionally, if I send a little bit extra every 2 weeks as my estimated payment, it's kind of a way of setting some extra money aside. And then I fill out my tax return. As expected, I paid a little bit too much. And then I get all that back at once. I get this big check. I pay off some debt. I buy a TV. I take a vacation. It feels good. Sounds good. Maybe it's a way to annually fund a certain goal that you have to fill the emergency fund, for example. But as financial planners, we talk about it a little bit differently because we recognize that if we're getting a refund, that does mean we've sent a little bit too much every paycheck every quarter to the IRS. We're letting them hold that money. They don't pay us any interest on that money. And then they give it back to us interest-free 16 months later, next April. Well, if we recognize that, we realize we can change that withholding amount. That refund means we have lower monthly cash flow. We have a smaller net paycheck, and we can change that. We can get a little bit more out of each paycheck instead of that big refund at the end. And maybe we can use that to help cover our bills, to pay more of our debt during the year. It may be an opportunity that we've lost to invest that money and earn some interest on those dollars. So it's a very personal decision, to be quite honest, on whether you should or shouldn't get a refund. Feels great. It's a way of saving without really thinking about it. Maybe it's forced savings. It's how you fund your goals. But as long as you understand that there is an opportunity to take a little bit of that refund every paycheck and get it throughout the year and use it throughout the year for various purposes. So first action item, although it's not on the screen, I do want you to kind of think about your philosophy around that refund. Is it okay to get a refund? Do you get a refund today? How much is it? And if it's $1,200, that means you can have an extra $100 every month during the year in your paycheck and get a zero refund. And is that better? Is that preferable to you, or do you like getting that refund? So we've talked about this pay-as-you-go system. We talked about sending money in or an estimate of what our taxes are going to do. And you think, well, now that I realize if I don't pay enough, I just paid in April, maybe I can really take advantage of that. Maybe I don't send much at all to the IRS and I'll just pay it all next April, or really take advantage of the time value of money and just not pay anything until I fill out my tax return. Well, the IRS is onto that, of course. And they have a rule that says if you don't pay at least a close estimate to what you're really going to owe, we're going to charge you an underpayment penalty. And there's a calculation that's done in your tax return if it's needed. If you look at how much you actually owe when you settle up and you say you owe $10,000, they say, well, I've only paid you $1,000 during the year. Guess what? You're going to have an underpayment penalty. There's two ways, though, to test that and make sure that you don't have an underpayment penalty at the end of the year. So let's just pause right now and talk about those two, what we call safe harbor rules, to make sure you don't have an underpayment penalty when you fill out your tax return because you paid way too little during the year. The first test, or the first rule, is that you pay at least 90% of what you ultimately owe. So when you fill out your tax return and it says, now that we know your real numbers, you owe us $10,000, and you say, great, I've already paid you $9,000 during the year last year through withholdings, $9,000 is 90%. You're going to have to write a check for $1,000 to finish off your payment, but you won't have an underpayment penalty because the IRS said you got close enough. You paid at least 90% during the year. Just pay us the rest right now and we're even. So that's the easier test, but it takes some calculations during the year to make sure you're on track for that 90%. The easier test is the second one, which says, hey, as long as you pay 100% of the tax that showed on last year's return, you're safe this year. So if you look at last year's tax return, and the time to do this is right after April 15th, when you file your return for 2022, look at the line on page 2 that says total tax due. Let's say that's $8,500. As long as you send at least $8,500 to the IRS during 2023, you will not have an underpayment penalty next year. You may owe some money because you didn't pay enough in, but you won't have an underpayment penalty because you paid 100% of last year's number. Again, all we're doing is just making sure that you don't have that underpayment penalty, and the IRS gives us two ways to guarantee that. As long as we paid in at least 90% of what we actually owe or 100% of last year's number, we're safe. Okay, if you have questions on that as we get to the end, make sure you ask me. That's one of the more confusing areas, but important to understand both the concept and some of those safe harbor rules. All right, so we have this pay-as-you-go system. The IRS says, as you're in income, make sure you send us something. So how do we do that? We've talked about a couple of those. The primary one is withholdings. We fill out a form W-4. We give that to our employer, and that information tells them, based on some IRS tables that they reference, how much to withhold out of each paycheck based on your pay and the information you put on that form W-4. If you want to change how much is withheld because your refund's too big or it's not big enough, you change the W-4, and that tells your employer to change how much gets withheld every paycheck. Instead of withholdings, perhaps if you're self-employed or you have other types of income like interest or dividends that don't have withholdings, you may have to make estimated payments. The IRS says you can make your payments quarterly. You just have to pay a tax or an estimate of the tax on all the income you earned that quarter. So at the end of the quarter, you look at what you earned, look at how much you had withheld. And if you owe more, you might owe more, then you can send it in with a coupon. It's called a quarterly estimated payment and pay your estimated payments that way. And then at the end of the year, you settle up. And if you still owe something, then you write a check with your tax return. There's three primary ways that we pay our taxes during and after the year end. So as we come back to that Form W-4, which is what many of us will use, understand it's based on a number of factors. The table that your employer uses from the IRS and the information you've put on the form that ultimately tells them how much to take out. It's based on how often you get paid, whether you're single or married, and that's how you're filing your tax return. It matters whether you have multiple jobs, because that table works differently if you have multiple jobs, because looks like you have two lower paying jobs, but when you add them together, it's a higher pay, and it puts you in those higher brackets. Does your spouse work? That's part of the Form W-4. Do you have any dependents where some of those child credits may be available to you? Do you have other income that will be part of your tax return? Are there certain deductions you're going to take? And is there an extra withholding amount that you want to have added to your withholding every time you get paid? So you could tell your employer, let's just run the form and see what that formula tells you to withhold. But whatever that number is, take an extra $100 out and send it to the IRS just to be safe. And it might mean I get a bigger refund, but that's okay. So you can add an extra dollar amount on the end of that form as well. So as we see, that W-4 is really important, and it's something we can update whenever we choose to. But we certainly recommend if you get married or divorced, if there's a birth or a death in the family, especially a dependent. If you buy or sell a home, you get a pay raise or a bonus. If you have other income like a capital gain or loss or some dividends, some investment income, certainly if there's tax law changes or they change the rates, those are times to revisit that W-4, fill it out again with your updated information. That withholding amount's going to change because your tax return is going to change. And the new W-4 that the IRS came out with a few years ago is much more detailed. And it is actually specifically designed that if you fill it out correctly and everything you put on there is right, including other income, your family members, that tax return should come out pretty darn close to zero based on the withholding that comes out of that W-4 form if all of your information holds true. It used to be it was a little bit more of a kind of a wild, not a wild guess, but a broader estimate of your withholding. The new form gets very accurate if you take the time to fill it out correctly, and you'll find your tax return gets darn close to zero, a small refund or a small amount due, but not some of the bigger refunds that we've seen in the past. Again, because you're withholding the correct amount. So how do we update this W-4? In the church world, it's a little different because your employer is probably your local church and everyone does it a little different. You may be the one that actually processes the W-4, or you may have an office manager that does that. But the IRS has a withholding estimator on irs.gov that you can walk through. It asks you all those questions, and the end result will tell you exactly how to fill out your Form W-4. You can fill it out. You can print it right there. You can turn it into your employer and update that form as needed. So for you as the next action item, I would visit the IRS website. You see it on the top of the page. It's irs.gov/W4APP for app. Go through that tax withholding estimator, answer all the questions. You'll see it's much more detailed now if it's been a while for you. And the end result is your Form W-4 and exactly the information you need to put on there. If you have any trouble with that form, you have a difficulty getting through it, don't understand a question, you can always call the EY Navigate Planner line. This time of year, that's one of our common questions. Help me with my withholding. Should I change it? How do I fill out the form? What are they asking me on the IRS website or in the W-4? And we can help you along the way. I mentioned the quarterly estimated payments. I just wanted to provide the dates. Again, this is primarily for folks that are self-employed that don't have withholding on a paycheck or have other income outside their paycheck that doesn't have withholding on it. Then they have to make an estimated payment every quarter of that income's tax or the tax that might be due. So you see the quarters, this year it's April 18th. There's a federal holiday. So good news, we get 3 extra days before our taxes are due and before that first payment is due. And then it's June 15th, September 15th. And then the last payment, they let you wait until the year ends. So you can look at your total income for that last quarter and you have to pay that last estimate if needed by January 15th. You'll also note those quarters are not evenly split. From April to June is just 2 months, for instance. So make sure you note those dates if you are someone that has to make quarterly payments in addition to your withholding. Just a few more resources as we get close to the end that I think you may find valuable to help you along the way in this process. Again, you always have your EY financial planner, but you also have the PBUCC Clergy tax return prep guide. If you've not accessed this before, it's published every year. It's in final review right now. It'll be published on the PBUCC website. Do jot down an action item to grab this fantastic document, especially if you're clergy, to understand the nuances of things like the housing allowance and such, to make sure that you're doing your tax return correctly. You see a prior version picture of one here, last year's, but the new one is on its way. It'll be on pbucc.org to make sure you get that tax return prep guide as soon as it becomes available. I mentioned housing allowance, and for those that are watching this webinar, either live or recorded, if you're clergy, I'm sure you're aware of the housing allowance, some more familiar than others. Today, we're going to talk about the fact that it is available to you not only as active clergy, with most of you know, but also in retirement. So as an active clergy, the housing allowance is a tax benefit that says that some or all of your clergy pay may be excluded from gross income because it's designated or counts as a housing allowance exclusion. And if some of your pay is not going to be taxed on your tax return, it may allow you to adjust your W-4 and reduce your withholding on your pay to get more on each paycheck, knowing that when you fill out your tax return, some of that pay will be excluded from tax thanks to the housing allowance. So one, it's important to know the housing allowance exists, and we'll talk next about how it works, but also understand the impact of that. It changes what your tax return looks like. When you settle up with the government, it may mean you owe less tax and you get more back, or you can adjust your withholding now and get more in each paycheck as a result. But importantly, the housing allowance continues into retirement. As long as your retirement benefits are paid to you out of a church plan, PBUCC, the annuity plan, or the RSA, some or all of those withdrawals and annuity payments can be considered housing allowance excludable as well. Works in the same way, as long as the money is coming from a church plan or church pay, the housing allowance applies. And a lot of folks miss that this carries over into retirement. Understand, this is very important, that if you take some of the dollars in your plan, and some of those are annuitized immediately, but you do have some dollars you can have flexibility with and even roll out into, say, an IRA. If you roll it out of the church plan, the housing allowance goes away. The housing allowance only applies if the dollars are coming to you from a church-sponsored plan. So again, here, that's the annuity plan or the RSA. That's a lump sum. That's monthly payments you receive from those plans. And again, that impacts how much tax you actually owe, and therefore it could impact how much you have withheld or the amount of those quarterly estimated payments you might have to pay during the year as your estimate of the tax that's going to be due. So this applies while you're active and in retirement. And here's how it works. For those that need a reminder or refresher on the housing allowance, the amount that you can take and exclude from your income is the lesser of 3 numbers. While you're an active clergy, it's the amount that your employer designates as housing allowance. Or if it's a retirement payment from the plan, the amount that PBUCC designates as housing allowance eligible. And I'll tell you right now that they annually designate the full amount as housing allowance eligible. But this must be officially designated. It has to happen ahead of time. So for your local church, when you're getting paid, your church board, or however your governance works, needs to officially designate in advance of the year that some portion of your pay is housing allowance eligible. It has to be recorded in the minutes of a meeting or somehow otherwise officially recorded and noted before you receive that pay. And then that's the first one. So typically that's the full amount. So all of it we say is housing allowance eligible, but we've got 2 other tests. We have to look at the actual expenses that you may have for your primary residence. If you buy a house, your mortgage, principal and interest, your utilities, taxes, insurance, maintenance, furnishings, all of the expenses of that residence, add those up for the year. We can look at that number. And then the third number we look at is what the fair rental value of that home would be, which includes furnishings and utilities, but also the rent, the fair market rent that would be charged for a house like that. And then we compare those three numbers. So if I get paid $30,000 and my employer says all of it's eligible for housing allowance, the first number is 30. But if it actually costs me 24,000 in true expenses for my house, mortgage or rent, mortgage or rent, utilities, furnishings, maintenance, all of those costs. And then I decide the fair rental value of this property would be, with furnishings and utilities included, $28,000. I look at all three numbers and I get to take the smallest of the three as an exclusion off my income or off of my retirement payments as the housing allowance exclusion on my tax return. I do this every year as an active clergy. I do this every year in retirement if I'm receiving retirement payments from a church plan. I always look at the three-prong test, and I always need to take the smallest of those three test numbers, and that's my exclusion amount. This is certainly an area of confusion. It's one that a lot of clergy know very little about, often don't take it. So please do call the EY Navigate Planner line. It's a conversation we have every day, especially the first quarter of the year as you do your taxes. And it's something we can help you understand, help you work through, and even help you with the calculator that we have on the EY Navigate website. That will help you calculate these three numbers and help you determine which number is appropriate to use. Last resource I'll mention today is EY Tax Chat. As you might know, EY is a global tax firm, among other things. We've got well over 100 years of doing company and individual tax returns. And we have a service that allows individuals to get their tax returns done through EY tax preparers, and it's called EY Tax Chat. And we have a partnership with PBUCC that offers a discount for PBUCC members that decide to do their tax return through EY Tax Chat. Certainly not required. You have lots of options to use to get your tax returns done every year. EY Tax Chat is a digital driven tax return process, but it's built behind actual EY tax preparers. So an EY person is doing your tax return, but all of the interaction, all of the data collection is done electronically, seamlessly through our EY Tax Chat website and app. So when you register on EY Tax Chat, and you can look in your app store and find EY Tax Chat and download it. Once you register, you'll answer a few questions. From there, it'll give you a quick quote on what the tax return might cost. Once you accept that, you don't pay for it yet. You answer a few questions about your family situation. Are you married? Do you have kids? What kind of income do you have? From there, you'll upload your documents simply by taking pictures of your W-2 or scanning those in and uploading them through the website. Once we receive those, you'll be assigned an EY tax preparer that will connect with you through the app, and you can chat back and forth through the app. If things get complicated, you can have a telephone call. We'll prepare your return, send it to you electronically through the app. You approve it, and then we file it for you electronically. And only at that point, when we're ready to file, do you pay the fee for your tax return preparation. If you decide to use EY Tax Chat, the first thing it'll ask you to do is register, and it'll ask you for a company code. If you put in PBUCC 30 as the company code, it will give you a $30 discount off the price of your tax return. And just note that the price of the return is based on the information you provide. So if you have a more complex return, maybe you have to file a couple of different states, the fee might be higher. If it's just one state and a W-2, it's going to be a lower cost, and you get that $30 discount regardless off of your tax return preparation. So simple process, find the EY Tax Chat app or the website, sign up and register using that code PBUCC30, and then just let EY guide you through the process, answer questions, take pictures of your documents. Your planner, your preparer will reach out, they'll prepare the return, give you the fee quote, you'll pay it, and then we'll file the return, and your taxes are done for the year. Again, if you have questions on that or anything we've talked about today, please do let me know. There's the process in simple form. Answer a few questions, get your price quote, chat with your preparer. We'll send you the return. We'll give you a chance to look at it, authorize it. We'll file it, and you pay the fee. Last reminder on EY Navigate, again, you have full access at no cost to you of your own financial planner for any financial planning questions, conversations, plans, including tax questions, housing allowance, help with EY tax chat, or anything else you might need. The ability to work with the same planner at all times, and the ability to do this on your own if you prefer through the EY Navigate website and app. With that, I'm going to pause for a minute and see if you have any questions. We will open the lines. I'll invite you to go off of mute if you have a question, and we've got plenty of time for those. I'll stick around as long as needed. I'll check the chat as well to see if we have any questions there.
Hi, Dan. I just posted a question on the chat regarding how Social Security tax is handled on the housing allowance.
So if I understand the question right, and I think I do, so the housing allowance will not eliminate the self-employment tax, just the regular federal income tax. So I think that's the question. And if it's not, there is a related question that we often get. If you're receiving Social Security, so if this isn't the question, here's a bonus. When you retire and you're receiving Social Security benefits may be subject to income tax. And there's a test that you have to do where you look at any other income you have on your tax return, you add in half your Social Security check, and based on that number, that tells you how much of your Social Security has to be taxed. Which just means that some of your Social Security in some years may be taxable, some years it may be not. When you're adding your income together for that test, you do not have to add back in the excluded amount for housing allowance. So that excluded amount remains excluded when you run the test to figure out how much of your Social Security check is taxable. That will make a lot more sense when you're retired and you're going through that process for the first time. You still have access to give us a call and walk through that. I think this question is about self-employment tax, and the housing allowance exclusion does not offset self-employment or the FICA tax is just regular federal income tax. And second question, can someone just exclude something in the way there? Exclude rent for housing allowance, or do they have to claim utilities, furnishings? So when you say claim, you're not deducting them. You're just looking at anything you paid for during the year.
Right.
Again,
but I'm saying that do you have to claim everything, utilities, furniture, or can someone just do their rent or their mortgage?
Well, it's to your benefit to throw in everything you can, if I understand the question right, because you want to try to get to the highest number you can. You're limited to the smallest of the three, but when we look, let's go back a couple of slides, if we could. So, so when we look at that, the first one is just the amount designated. That one's easy. It's given to you. The second one is everything you actually spend cash on, your mortgage check, any furniture you buy, all your utility bills. And again, you want to pull in as many of those as you can to get that number as large as possible. The third one is what you would expect to rent that home for if you put it on the market, including the cost to furnish the home and the expected cost of utilities. Again, you would want to add all of those together to get that number as high as possible, because you're limited to the smallest of the three. So there's no downside to including everything that you pay for or would pay for if you were to rent that place as a furnished apartment or house.
Okay, thank you.
Hopefully that answered the question.
Yes, it did. Thank you.
Yep, so no downside in including everything.
Dan, I just have one question. Going back to the housing allowance, if it's still subject to the Social Security tax, how do you make sure that that amount is included in your in the W-4?
Or on the W-4 or on the tax return itself?
Well, like because I noticed that when I have all my monies taken out, it's based on my base salary, not my housing allowance, but I have to pay special taxes on the housing allowance. Yep. And how can I include that amount in terms of what's being taken out?
And are you talking about during the year for your withholding on your paycheck, or?
Yes. Okay. So because I'll end up, I usually come up owing at the end when I calculate the amount from that.
Okay, so and I'm not sure if this is your question or maybe a little different. So when you talk about the Social Security, you're talking about the FICA tax that's on your paycheck, correct?
Yes.
So every 2 weeks you get paid, let's say it's $1,000, but they take some out for federal tax, they take some out for FICA tax, right? So that
Correct.
$1,000 you start with, that is your full pay. You're going to take the housing allowance exclusion off your tax return. So let's just, for simple numbers, let's say you get paid $2,000 a month. So it's $24,000 for the year. Your W-2 at the end of the year is going to show you made $24,000. You'll put that on your tax return, but then you'll reduce that number on the tax return by your housing allowance. So the housing allowance doesn't come into play on your paycheck.
Okay.
So that full 2,000 will be subject to withholding for federal tax purposes, and the full 2,000 will be hit with that FICA tax. So you'll pay your full FICA because your full pay is included in your paycheck.
Okay. So
the
then,
FICA is paid during the year correctly, and then when you do your tax return, that's when you take off the housing allowance and therefore pay less federal tax because you're showing less income just on the tax return.
okay.
But you've already paid the full FICA through your paychecks.
Okay.
So the FICA just kind of just takes care of itself. Your full pay is reported on each paycheck, and the full FICA tax is calculated and taken and sent off to the Social Security and Medicare systems, and you're done.
Okay.
And the housing allowance is just part of the tax return. Hopefully
Yeah.
that helped, but you're fine with the FICA tax during the year on your paycheck because the housing allowance doesn't come into play until the end when you do the tax return.
Okay.
Yep. See, nothing else in the chat. Anyone else that's on live have a question? And again, if you haven't already, I think the best thing you can walk away with a few specific takeaways. If you're looking for a place to do your tax return, consider EY Tax Chat. It's EY professionals doing your return. The app just makes it real easy to upload your documents and makes that process of data gathering simple. Do get the tax guide from PBUCC, which is extremely valuable to have to download, and certainly take advantage of EY Navigate. You have your own free financial planner. You go out and hire one on your own. It's $150 an hour, and it's at no cost to you. And they can talk about anything financially. It's all confidential. So even if you're not sure you need to have a conversation, give us a call and just say, just tell me what you do, or what are some of the kinds of questions you get. And maybe there's something I'm not thinking about. And we get those calls every day. So you're welcome to make that phone call, even if you don't have a specific question. And with that, Travis and Judith, I will turn it back to you for any closing comments or anything I might have missed, but I appreciate everyone's time today. Thanks.
No, thank you so much, Dan. It doesn't look like there's any further questions. So we really appreciate your time. And again, anyone that's watching this on the recording, don't hesitate to reach out to EMY to ask questions about tax withholding or the EMY tax chat. So again, thank you, Dan. And we look forward to hear from you soon.
Sounds good. Thanks, everyone.
Thank you.
Bye.